For Hong Kong, which holds over $255.9 billion in U.S. Treasuries, U.S. Treasuries have long been considered a safe haven. In times of global economic uncertainty or market volatility, investors flock to these securities for their stability, liquidity, and the promise of regular interest payments. For a small but economically influential territory like Hong Kong, which serves as a major global financial center, U.S. Treasuries are not only an important component of its foreign exchange reserves, but also a strategic asset that helps maintain the stability of its currency pegged to the U.S. dollar. Here's a graph on the largest holders of U.S. Treasuries as of January 2025, data from the U.S. Treasury Department. Here, one can see that even though Hong Kong isn't the largest economy on the list, they hold a substantial share of over $255.9 billion, making them a larger holder as compared to Singapore, Germany, South Korea, and a long list of other nations. But what's more interesting about these holdings of $255 billion in US Treasuries is the fact that Hong Kong's economy isn't even that big. Hong Kong, if we graph out their nominal GDP, we get to see that as of 2023, their GDP stood at just $380 billion, meaning that its US Treasury holdings of $255 billion is about 50% of its total GDP. This ratio is strikingly high compared to other economies of similar size. And on top of the fact that they hold so much US Treasuries, one can also look at China. China, if we graph out their holdings of US Treasury, has been seeing a decline. Although the graph only depicts the past few years, China's holdings of US Treasury have been consistently declining. Here, you can see that in just 2 years, from January 2022 to January 2025, China's holdings of US Treasuries declined from over $1 trillion to just $760 billion. This decline in their holdings of US Treasuries is attributed by their drive to de-dollarize, which basically means that China is reducing its reliance on the US dollar in global trade and finance. Instead of holding large amounts of US Treasuries, China has been diversifying its reserves, buying more gold, increasing its holdings of other foreign currencies, and boosting the use of the yuan in international transactions. Hong Kong, however, if we graph out their holdings of US Treasury in the past few years, we get to see the exact opposite. Despite being part of China, Hong Kong has actually seen its holdings of US Treasury to increase from $225 billion in 2022 to over $290 billion by 2025. It's not a big increase, but it's the exact opposite of what China has been doing. As a territory of China, shouldn't Hong Kong be following the steps of China's pursuit of de-dollarization? Well, that's one of the many questions that we'll try to understand in today's video. We will be discussing why Hong Kong holds so much US Treasuries and why they continue to buy them, despite China's overall goal. Let's first start with the basics and talk about what US debt is. US debt in its simplest form is basically the money borrowed by the US government to fund its operations, infrastructure, and various programs. The government issues US Treasuries, which are bonds that investors, both domestic and foreign, can buy. In return, the US pays them interest at a fixed rate. These treasuries are considered one of the safest investments in the world because they are backed by the US government, which has never defaulted on its debt. This is one of the biggest reasons why economies, like Hong Kong, hold so much US debt. That is because they are safe. They are arguably safer than any other investment in the world. US Treasuries are backed by the full faith and credit of the US government, which has never defaulted on its debt. Secondly, they provide yield. For Hong Kong, which holds over $255.9 billion in US Treasuries, they can generate anywhere between $8 billion to $12 billion annually in interest income, depending on the prevailing US Treasury yields. This is a significant source of passive revenue for Hong Kong's monetary reserves. If Hong Kong were to hold cash, they wouldn't make any money. In fact, they would lose money due to inflation. The same can be said for gold, which is a famous component of foreign reserves. gold, while a reliable store of value, does not generate passive income. They simply sit in reserves and fluctuate in price based on market demand. Then, thirdly, and most importantly, is the fact that they are highly liquid. What that basically means is that Hong Kong can buy or sell US Treasuries almost instantly without significantly affecting their market price. This is crucial for a financial hub like Hong Kong, where maintaining stability and quick access to funds is essential. And this is why Hong Kong needs a lot of US Treasuries: liquidity. Hong Kong always needs cash. Why is that? It all lies in the fact that the Hong Kong dollar is tied to the US dollar under a linked exchange rate system. If we graph out the Hong Kong dollar's exchange rate to the US dollar over time, we get to see that not just for years, but for decades has the Hong Kong's dollar's value to the US dollar remained within a narrow band, typically between 7.75 and 7.85 Hong Kong dollars per US dollar. This stability is a direct result of Hong Kong's linked exchange rate system, which has been in place since 1983. This is the exact opposite of most major economies' currencies. If we graph out China's yuan's exchange rate to the US dollar, we get to see that it fluctuates much more significantly. So, what's the connection between having US Treasuries and Hong Kong's peg to the US dollar's value? Well, it's the fact that US Treasuries act as a financial backbone for Hong Kong's linked exchange rate system. Since every Hong Kong dollar in circulation must be backed by US dollar reserves, the Hong Kong Monetary Authority needs a massive stockpile of US assets to ensure it can defend the peg when necessary. For instance, back in 2022, it was reported that the Hong Kong Monetary Authority had bought over $1.5 billion from the market to stop the local currency weakening and breaking its peg to the US dollar. The reason why they have to do this is because if the Hong Kong dollar weakens too much, it could break the peg and trigger financial instability. That basically means if Hong Kong didn't have a large enough reserve of US Treasuries and US dollars, it would struggle to maintain its currency peg. Had they hold gold, for instance, and not US Treasuries, it can cause instability as they wouldn't be able to immediately defend the Hong Kong dollar's peg to the US dollar. But just how does this really work? Well, picture this. Imagine Hong Kong's financial system as a dam that regulates water levels. The Hong Kong Monetary Authority acts as the gatekeeper, controlling the flow of water, which is basically the flow of money, to keep the system stable. Now, think of US Treasuries as the emergency water supply. Whenever the dam needs more water, liquidity, the HKMA can quickly release reserves by selling US Treasuries and converting them into US dollars. This ensures that the Hong Kong dollar remains within its fixed exchange rate band of 7.75 to 7.85 per USD. Hence, their holdings of US debt can't make them follow China's path to de-dollarization. They just can't do what China is doing right now because their currency is pegged to the US dollar. Will it be possible that in the future, Hong Kong would reduce its exposure to US debt and in turn possibly follow China? Well, the answer is quite complex. For one, they can't simply abandon US Treasuries overnight. The entire foundation of Hong Kong's financial system is built around the currency peg, and that requires massive reserves of US dollars and US Treasury securities to maintain stability. So, for them to reduce US Treasuries, they may need to either cut their currency peg to the US dollar, or China's yuan internationalization must succeed. China's yuan internationalization, however, as of the current landscape, isn't still the dominant global currency that could replace the US dollar. Investors still prefer to hold US dollars because of its stability, deep liquidity, and global acceptance. So, as you can see, Hong Kong's significant holdings of US Treasury securities and its ongoing purchases of US debt are driven by its need to maintain its currency peg to the US dollar. But of course, there are a lot more reasons out there than just this. We shouldn't also ignore the fact that Hong Kong is a global financial hub.